The latest edition of Nigel Farage's Fortune and Freedom newsletter is out today, and it is peddling more fear, making the ludicrous suggestion that UK savers could lose their deposits as part of a so-called bank bail-in. So in this video, what is wrong with Nigel Farage's cash saving scaremongering and things to look out for, especially what I fear is coming next from Fortune and Freedom. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice, and today, because I am a glutton for punishment, I read the latest edition of Nigel Farage's Fortune and Freedom investment newsletter. Now, I know the first rule of social media and being online is you don't feed the trolls, but I am genuinely concerned and a little bit outraged about some of the suggestions made by the newsletter editor Nikolai Hubble in today's newsletter, really peddling fear, lots of cash saving scaremongering taking place. So I wanted to look at some of the things that were very wrong with the suggestions made in today's newsletter, and also give you a bit of a warning about what I think might be coming next from Fortune and Freedom. Now, today's newsletter is based on a bit of a follow-up from a previous claim made by Fortune and Freedom's editor. So in a previous newsletter, he said the next time a bank in the UK fails, the depositor's money could be taken to fund the bailout. They call it a bail-in. Now, that claim when he first made it was utter nonsense, and I have to say it's still utter nonsense. I want to explain why. I think the best way to overcome this sort of fear and scaremongering is to shine daylight on it and give it the bare facts so you can understand why this is scaremongering, why this is fear, why this is incredibly unlikely to happen, and then think about really what the motivation is for trying to scare you away from your cash savings. So Hubble is referring to a European Union directive, the Bank Recovery and Resolution Directive. It is nothing new. It came into force back in 2014, and in summary it says the EU's bank resolution rules ensure that the bank's shareholders and creditors pay their share of the costs through a bail-in mechanism. Shareholders and creditors, not cash savings account holders. That's a really important line from that one. And this is something that was already broadly in force here in the UK. In fact, back in 2009, this came into force with the Banking Act 2009. And that Act of Parliament introduced a special resolution regime, which was designed to ensure that there was an orderly failure of banks should banks fail in the future. When the EU came along in 2014 and introduced a directive, the UK simply updated their existing law and brought it into line with that EU directive. So it's fair to say that this law and then this directive is about protecting consumers. It's about ensuring the security of the UK banking sector. It is not about the ability to tap into savings accounts and steal money, despite what Farage and Co would have you believe through their newsletter. In today's Fortune and Freedom newsletter, Hubble says, having reviewed over the last few days just how wobbly Britain's banks really are, not to mention what the coming negative interest rate would do to them, I think it's important you know how a banking crisis will play out for depositors. Now, it won't surprise you to hear that the UK banking sector is heavily regulated. And part of that regulation is ensuring that banks in the UK, as they are across the EU, are financially secure. They have enough capital adequacy to withstand not just temporary dips in the economy, but significant. One of the stress tests that UK banks are subjected to is to make sure they can survive a 30% drop in the size of the UK economy. Now, even with the severity of the COVID-19 pandemic and the impact that's had on the UK economy, we've seen nowhere near a 30% drop. We've not even seen a 15% drop. And again, that was very temporary. That wasn't a long-term sustained thing. It was down sharply. It recovered sharply the following quarter. So it is scaremongering to suggest that the UK banking sector is wobbly. It's certainly not wobbly. The parts of the law that look at the bank's capital adequacy are also EU directives. So we have the Capital Requirements Regulation and the Capital Requirements Directive. And capital in this context, the money available to the banks to make sure they are capitally strong, does not include your cash deposits. That is not included in any of the definitions of capital adequacy. Banks in the UK and also in the EU have to have a minimum level of capital adequacy measured as a ratio, and that ratio, depending on how you define it, is anywhere between 4.5 and 8%. So a significant amount of actual assets available to shore things up should things go wrong in the wider economy, should the banks need to tap into some reserves. Now, the latest update on capital adequacy and capital ratios from the Bank of England was published in October, so only last month, and it shows that the Common Equity Tier 1 capital ratio, so that's one measure of capital, for the UK banking sector as a whole, increased by 0.7% to reach 15.7% overall. And then the level of CET1 capital, which is another capital ratio measure, increased by 3.4% on the quarter, from £453 billion to reach £468 billion. That was in the second quarter of this year. And there was also a 1.1% decrease in the total risk-weighted assets, and that again is a positive improvement in the capital ratios of the banks. So to say the UK banking sector is wobbly is utter nonsense. The UK banking sector is not wobbly. In fact, just yesterday, City Index reported that there is a growing expectation that the worst is behind us when it comes to bank savings. So the big question in today's edition of the Fortune and Freedom newsletter is this: is your money safe in the bank? And I could probably end the video here by saying, in short, yes, it is. But I'd like to give you the longer answer, the more detailed explanation, to hopefully give you some reassurance to combat this scaremongering we're seeing from Nigel Farage and Nikolai Hubble. Now, the longer answer means looking at some of the more outrageous claims made in today's newsletter. And Hubble writes about a lady called Sharon Conor. Sharon lost around £42,000, apparently taken by the bank in Cyprus. And I wasn't familiar with this case, so I had to look it up. And there was a report in the Express from April 2013, so about a year before the EU bail-in directive came into force. Keep that in mind. And the report in the Express is a very sad story. There's no getting past that. So Sharon Conor was an expat, British expat, who lived in Cyprus. Her husband tragically died, and she decided to sell their villa in Ayia Napa in Cyprus and then use the proceeds to move back to the UK. Now, the timing was incredibly bad. She sold the villa, the proceeds went into the bank account, into the Bank of Cyprus, and then the following day we saw the Cypriot banking crisis really explode in her face. And as a result, there was a bail-in and a bail-out mechanism agreed between Germany and Cyprus. So again, think all the way back to 2013. Cyprus was very much the sick man of Europe back then. The banking sector in Cyprus was a complete shambles, a complete mess, and Germany stepped up to fund that. In simple terms though, Germany agreed to put around $13 billion, obviously in euros, into the Cypriot banking sector. And to cover that, the Cypriot banking sector agreed to levy a one-off tax on savers' deposits of $7.5 billion. And the tax rate was two parts. For insured deposits, so deposits up to €100,000, it was charged at 6.75%. And then for what are called uninsured deposits, so deposits over €100,000, it was charged at 9.9%. And this was nasty for Cypriot savers. The only way the Cypriot government could secure this bailout from the German government was to agree to impose a one-off levy on savers, mostly on uninsured deposits over €100,000, so wealthier savers. Now, Sharon O'Connor had €183,000 in two bank accounts with the Bank of Cyprus. That money included the proceeds from the sale of her villa in Ayia Napa. And as I mentioned earlier, the timing was awful. But there are a couple of points to mention here, and I'll refer to my notes as I'm doing this. Firstly, the UK banking sector of 2020 is not the Cypriot banking sector of 2013. I've just gone through the capital adequacy levels. Cyprus was the sick man of Europe. Cyprus had a real issue with its banking sector. They had taken on risky debts. They were not capitally secure, and this was really their only option at the time. It's not fair to compare banks in Cyprus in 2013 with banks in the UK in 2020. Secondly, we have got protection under the terms of the Financial Services Compensation Scheme. I think most savers are aware of that protection. It covers up to £85,000 per saver per bank account. And that is a really strong protection. It's ultimately backed by UK government, but is paid as a levy by all regulated financial services firms here in the UK, including mine. So Informed Choice each year pays a levy into the Financial Services Compensation Scheme to compensate savers, investors, policyholders for any failed advice, any failed providers. So this is a robust system with the ultimate backstop of the UK government. But we have something here in the UK with our Financial Services Compensation Scheme, which is over and above what they had in Cyprus in 2013. And it's called the Temporary High Balance Protection Scheme. scheme. Not a lot of people are aware of this particular additional protection, and from reading today's Fortune and Freedom newsletter, it would appear that Nikolai Hubble is not aware of this either. And what the temporary high balance protection does is covers for up to a year a temporary high balance of up to £1 million. So when in the Sharon Conor case we were talking the difference between insured and uninsured deposits, here in the UK, if it's a temporary high balance, that can be up to £1 million of cover. It's a very, very different circumstance. Now, certain life events can cause this temporary high balance in your bank account, including real estate transactions. So in that Cyprus example where the villa was sold in Ayia Napa, money went into a bank account and it temporarily pushed up the balance until that money was taken back to the UK and used to purchase property here. That in the UK banking sector would have been protected by the Financial Services Compensation Scheme. There are other life events too, so benefits payable under an insurance policy, personal injury compensation, disability or incapacity payments, claims for compensation for wrongful convictions. There's a whole list of these, and I will link to the page on the FSCS website where it talks about temporary high balance protection in the description below, so you can read those, understand what is and is not covered. But Hubble does not appear to be aware of this in today's edition of Fortune and Freedom, because he writes, if you happen to sell your home on the day of the bank bail-in or decide to take a lump sum pension payout, you may have more than £85,000 in the bank. You could be caught out. Well, no, because as we've explained, the Financial Services Compensation Scheme offers this temporary high balance protection. So you could sell your home or receive a tax-free cash lump sum from your pension, and you would not be caught out should this happen, and you were very, very unlucky with the timing of it. Now, it is incredibly important to keep cash deposits here in UK banks below that FSCS level of £85,000, or in the case of a temporary high balance protection, £1 million for 12 months. The chance of a bank in the UK going bust is incredibly slim, but why take that risk when you have access to the FSCS and its deposit protection limits? Spread your money around if you need to. If you have to, if you've got sufficiently high balances, it might be worth looking at a cash management plan, and this takes the administration hassle away from spreading your money between bank accounts. It also makes sure that they are looking around for the most competitive interest rates for you. There aren't many competitive interest rates now with interest rates so low, but they do that heavy lifting for you. So for our clients who have significant cash balances, we'll often recommend a cash management scheme to help spread the balances around between bank accounts, but certainly take advantage of those FSCS protections. Now, I am genuinely worried that all of this rhetoric about wobbly UK banks and bail-ins and FSCS protection limits changing or falling away is the precursor to a massive sales push. So thinking ahead to what's likely to come next from Fortune and Freedom, I think you're going to unsettle readers about cash and then try and drive them towards alternatives or so-called alternatives to cash. So what are we going to see next? Are we going to see some sort of gold investment scheme, maybe some Bitcoin, something like that? I think this is a clear play here, isn't it? It's unsettle the savers first and then try and encourage them to move their money from cash to something incredibly risky, incredibly speculative. So do watch out for when that happens next. Do let me know if you have any questions about cash protection, about FSCS limits, anything like that, or even about bank bail-ins. I can read the EU directive legislation just as well as you can. Until next time, thank you for watching this video. I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.